Ever wondered why some investors seem to have an almost magical touch with their investments? What if I told you that Warren Buffett, one of the most successful investors of all time, has revealed 3 brilliant secrets that could help anyone become a better investor? Today on No Money, we're diving deep into Buffett's investing wisdom. What does he really look for when choosing where to put his money? And how can these secrets help you make smarter investment decisions? Stick around as we unravel these timeless principles that could transform your approach to investing. Number 1. Understanding the business.
Most good businesses, you can understand what they're about in a very few minutes, unless they're a kind of business that you never can understand what they're about. I mean, there are other businesses, if you spent years on them, you still wouldn't understand what the hell's going on. I don't know which American auto company is going to do the best 10 years from now. And if I spent all year talking to dealers for Ford and Chrysler and General Motors, and I talk to suppliers, and I talk to people who are driving their cars, I still wouldn't know anything about what it's going to look like 5 or 10 years from now.
The first secret that Warren Buffett emphasizes is understanding the business you're investing in. This might sound obvious, but many investors overlook it. Buffett's approach is to only invest in businesses he understands thoroughly. In the early days of investing, Buffett focused on companies with simple, clear business models. He believed that if you couldn't explain how a business makes money in a few sentences, it wasn't worth investing in. This principle is based on the idea that complex businesses are harder to predict and analyze. Buffett's famous quote, "Never invest in a business you cannot understand," underscores this principle. He refers to it as the circle of competence. If a company's operations and business model are beyond your understanding, it's wise to stay away. For example, if you're not familiar with technology, it might be better to avoid investing in tech startups and focus on industries you know well. Buffett's success with companies like Dairy Queen is a testament to this principle. These businesses have simple, easy-to-understand models. By focusing on companies he understands, Buffett avoids unnecessary risks and makes more informed investment decisions. Number 2. Look for a durable competitive advantage.
Charlie taught me a lot about the value of a durable competitive advantage and a really first-class business. But over time, I've learned more about various types of businesses. But you'd be amazed how many businesses I don't feel that I understand. If you don't have to be an expert on 90% of the businesses, or 80%, or 70, or 50. But you do have to know something about the ones that you actually put your money into. I think if you think about what you would pay for a McDonald's stand, what you think you would pay for, think about the businesses in your own hometown of laughing, which you think it would be very tough to compete with. You will extend your knowledge over time, and always remember that margin of safety.
Buffett's second secret is investing in companies with a durable competitive advantage, often referred to as an economic moat. An economic moat is what keeps competitors at bay and protects a company's profits. A durable competitive advantage can come in many forms: strong brand recognition, exclusive technology, cost advantages, or regulatory barriers. Buffett seeks companies with a significant moat that will allow them to maintain profitability and fend off competition over the long term. For instance, Buffett's investment in American Express is a prime example. American Express has a strong brand and a loyal customer base, which are difficult for competitors to replicate. This competitive edge helps the company sustain its market position and profitability. Buffett once said, "The business you invest in must have a moat around it, and it must be wide enough to keep competitors out." A wide moat means that a company has strong defenses against its rivals, making it a safer long-term investment. These advantages create a strong moat, making it hard for new entrants to compete effectively. By focusing on businesses with durable competitive advantages, Buffett ensures that his investments are well positioned to thrive for many years. Number 3. Invest for the long term.
I'm not recommending that people buy stocks today or tomorrow or next week or next month, but you shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them, and you're not going to pick the bottom and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more. and be comfortable with it. There have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up? You've got to be in the right psychological position. And frankly, some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time. And
The third secret Buffett swears by is investing for the long term. Buffett is known for his patience and his commitment to holding investments for many years. He famously said, "Our favorite holding period is forever." This doesn't mean you should never sell your investments, but it highlights the importance of thinking long term. When Buffett invests in a company, he considers whether he would be willing to hold that investment for 10 or even 20 years. This long-term perspective allows investors to ride out market volatility and benefit from compounding growth over time. Buffett's investment in Berkshire Hathaway is a perfect example of this long-term approach. He has held on to this company for decades, allowing its value to grow exponentially. By focusing on the long-term potential of his investments, Buffett has been able to achieve extraordinary returns. Another notable example is his investment in Apple. Buffett recognized the company's potential for long-term growth due to its innovative products and strong brand loyalty. Holding on to Apple stock has significantly contributed to his portfolio's success. The key takeaway is to avoid making decisions based on short-term market fluctuations. Instead, look for companies that have the potential to grow and prosper over the long haul. This approach not only reduces stress, but also increases the likelihood of substantial returns. Practical application of Buffett's secrets. So, how can you apply these Buffett secrets to your own investments? Understand what you're investing in. Start by thoroughly researching companies. Make sure you understand their business model, products, and industry. If something is too complex, it might be better to skip it. Warren Buffett's approach is to invest only in businesses he understands completely. This principle helps avoid unnecessary risks and makes more informed decisions. For example, if you're unfamiliar with technology, avoid tech startups and focus on industries you know well. By investing in businesses you understand, you can better assess their potential and make smarter choices. Identify the moat. Look for companies with a strong competitive advantage, known as an economic moat. This could be a well-known brand, unique technology, cost advantages, or regulatory barriers that protect the company from competitors. Buffett seeks businesses with significant moats to maintain profitability over the long term. Examples include American Express and Coca-Cola, which have strong brands and loyal customer bases. A wide moat means a company has strong defenses against rivals, making it a safer long-term investment. Think long-term. Focus on investments that you can hold for years. Avoid making decisions based on short-term market fluctuations. Instead, look for companies that have the potential to grow and prosper over the long haul. Buffett's strategy involves considering whether he would hold an investment for 10 or 20 years. This long-term perspective allows investors to benefit from compounding growth over time. By adopting a long-term investment strategy, you align yourself with the principles that have made Buffett successful. Case studies. Let's look at some real-world examples to see how these secrets have played out. Case study 1. Coca-Cola. Coca-Cola exemplifies Buffett's principles. Buffett invested in Coca-Cola because he understood its business model and recognized its strong brand and global reach. The company has a wide economic moat due to its brand strength and distribution network, allowing it to maintain a competitive edge. Buffett's long-term investment in Coca-Cola has paid off handsomely as the company has delivered consistent returns over the years. Case study 2. Apple. Apple is another great example. Buffett has invested heavily in Apple, recognizing its strong brand and loyal customer base. The company's moat includes its innovative products and ecosystem, which are difficult for competitors to match. Buffett's long-term investment in Apple reflects his belief in the company's enduring competitive advantage and growth potential. Warren Buffett's investing secrets are more than just strategies. They are timeless principles that can guide anyone toward successful investing. By understanding the business, seeking a durable competitive advantage, and investing for the long term, you can make smarter investment choices and achieve better returns. If you found this video insightful, don't forget to subscribe to No Money for more valuable financial tips and strategies. Share your thoughts and questions in the comments below. We'd love to hear from you. Until next time, keep learning and investing wisely.